There is a lot of talk right now between the comparison between the economy of the 70s when they went through a stagflationary period to today, whether it's the high oil prices or the inflation that has run out of control. There's so many different comparisons, which we will go through today to determine, are we heading into a period of stagflation? But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, I have a huge favor, a huge ask. If you learn something new or you get some value out of the video, please hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on for similar content just like this. We're going to start off by talking about what stagflation is. So the first portion of the word is stag, a stagnant economy, an economy that is not growing and is slowing, heading into a recession. The second part of the word is inflation, and that is inflation, which has definitely been a hot topic on this channel and definitely everywhere throughout the world. You've seen it in news articles, you've seen it in so many different places. It is on the top of everybody's tongue right now. We're gonna start off by taking a look at what happened with the higher oil prices. We feel it today at the pump, but let's take a time travel back to see what happened back in the 70s. So why did oil prices rise back then? So we see here in October 1973, the United States supported Israel after a surprise attack by Egypt and Syria in the Yom Kippur War. This definitely did not go over well with the Middle Eastern folks over there. As you've probably heard, OPEC is a big portion of the oil supply, and they did not like that. So what happened? They put an oil shipping embargo against the United States as well as Israel's European allies. So what happens there? They took supply off the market, and when we take supply off the market and the demand is still high, it will cause prices to increase. So if we draw a comparison to what's happening today, it's almost a similar circumstance in the sense that oil from Russia is being taken off the market. And only a few weeks back, WTI, the Western Texas Intermediate, was trading at $90 a barrel. Over this past weekend, it rose to $125 a barrel. That's almost 40% in short 2 weeks' times. And I'm sure you're feeling that at the pumps. In Ontario, it raised over the weekend to about $1.84, and that's per liter. And in the US, I've seen it at over $5 per gallon. So that didn't even include the increase that happened over the weekend. So that will continue to rise, and we will continue to feel that pain. Now, it's not just gasoline that it's going to affect. It's going to affect so many different things, especially as the economies start to open up. We got to look at jet fuel as being a portion of demand. So we start opening up, we're going to increase our demand for gasoline, and now all of a sudden we're taking supply off the market. And this is definitely a strong comparison as to what happened in the 70s. Moving along, we're going to focus on inflation. Inflation's definitely been a hot topic on every news article you've probably read. We've covered it so many times on this channel. So definitely it is a huge concern, especially in the US, hitting over 7% of inflation, which is 40-year highs. In Canada, we're above 5%, which is numbers we haven't seen since the 90s. And this is similar to what happened back in the 70s. They had inflation in the double digits, like 10, 12% inflation, which was caused because of the Vietnam War. And they were printing so much money in order to afford that war. And you can almost draw a similar comparison as to us coming out of the pandemic and the massive amount of money that we've had to put into the economy because we've had to put towards social programs and keeping small businesses alive. So Vietnam War spending, pandemic spending, we're definitely along the same lines when it comes to that. And we're starting to see inflation increase. So if we take a look back at this period, we definitely see a rising Fed rate. Now, this has definitely been another portion of the inflation talk. which is that the Federal Reserve or the Bank of Canada will have to raise the overnight lending rate, which is the interest rate, because what they want to do is they want to curb inflation. And that's a way that they do it is they make money more expensive by raising the interest rate, my apologies. And when they do that, you're constricting the economy. You're really contracting it down so that you're making it harder for small businesses or businesses alike to go and get money to put out in the economy. So we see here in a 2003 speech, Ben Bernanke said about the 70s, the Fed's credibility as an inflation fighter was lost and inflation expectations began to rise. The Fed's loss of credibility significantly increased the cost of achieving disinflation. So it's almost similar to what we're dealing with today, with a lot of people have lost that credibility or lost that sense that the Federal Reserve knows what they're doing. And a lot of people are questioning if we can even raise the interest rate even more because we put so much debt into the economy. If we start raising the interest rates, people may default on that debt. So there are a lot of comparisons right now. And I know we've talked about interest rates. They are super low right now, the lowest we've ever seen in history. And to take a look at the 70s, we see in 66, the overnight lending rate was 5.5%, heading all the way up to the highest point in the 80s. It achieved 19.1%. So if you talk to anybody that had a mortgage in the 80s, they would have been paying much higher than the 2 to 3% that we pay today. So if you think about it, Ben Bernanke was saying that they lost the consumer's hope or the American economy's hope. And we can almost say that there's a lot of people that have lost hope as to where we're at today. So that is definitely a concern. And if we flip the script and we take a look at the 10-year Treasury bond in comparison to the 2-year Treasury bond, this has always been considered by economists as a good indicator as to where the economy is at. And if you see on the chart here, the closer it is to zero, it's showing that the economy is weakening. And that's kind of where we're at today. If we do fast forward and we look at the 2021 numbers, we see that approaching the zero mark. And if we look past through history in this max chart here, we see in the 1980s, it did dip below that, which we saw, obviously the stagflationary period continued for a decade. We then see it falling in the 2000 period, which is obviously the tech crash. And then we see it even most recently in 2020, obviously due to the pandemic. So we do see a slowing economy starting to come to us right now, which makes you almost think that we are heading towards a slowing economy and obviously fitting into that stagnant economy, the first portion of stagflation. So there is a lot of similarities right now, in my opinion. And obviously you're sitting here, you're saying, okay, this is not good news. What do we need to do? And I found this ETF that is looking to come online, and it's by a company by the name of Merck Stagflation. They're looking to put out an ETF, and it would cover stagflation sensitive asset classes. And the way that they would build it is they would put 55 to 85% of US Treasury inflation protected securities and between 5 to 15% of real estate, gold, and oil. So that is the way that they're going to make it up. It hasn't been released to the market as of yet. But if you're looking to stagflationary, protect your portfolio, these are some of the ways that I would look. Obviously, gold started to make a move even before the risks that happened in the crisis overseas. But the crisis overseas definitely helped that number. I believe gold is over $2,000 per ounce right now. So would I be buying on dips? I would definitely be looking at building a watch list with some of these names. If you're in Canada, an interesting way to look at the Treasury bond is an ETF called QTIP, QTIP.to. It's basically an inflationary protected Treasury bond. So take a look at those. Make sure your portfolio is protected, especially if the next couple years is going to be a period that we head into stagflation. Let me know down below what your thoughts are. Am I overthinking things, or can you see the similarities and comparisons of what we dealt with in the past, especially if you know that history does repeat itself? But if you're still here with me and you appreciated the content, please hit that like button. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. I hope you all have a great week in the markets. Happy trading.